Well, those are the headlines we'll be tracking for you all evening on ET Now. But for now, of course, let's get right to the Money Show and introduce our first guest. We have with us none other than Mr. Arun Kumar. He is, in fact, the head of research with FundsIndia. Mr. Kumar, thank you so much for taking our time and joining us on the Money Show today. So essentially, the idea is to discuss the different mutual fund categories. We know that apart from equity and debt, there are several categories within these two broad umbrellas of mutual funds. And last month, we've seen a lot of traction, as we have been for the last few months. Firstly, of course, there seems to be no respite. Net outflows continue from equity mutual funds overall as well. So that's going to be my first question to you, Mr. Kumar. Why is it that we are seeing continuously more redemptions than new investments in equity mutual funds, not for the last 2 or 3 months, but for the last 6 or 7 months now?
Yeah, thanks for having us. So broadly, if you look at the context of the last few years, not just last few years, even the last 10 years, 20 years, this is a pattern which is almost always repeated, that whenever there is a huge market crash, and post that whenever the market recovers and hits an all-time high, we have seen that there is a tendency for a lot of investors to immediately start booking their profits, because there is fresh in the memory the fact that there's been a large correction, and at some point in time it can always happen. And the second point is also on the fact that there's been a disconnect between the economy and the market for some point in time. But however, now if you recently look at it, a lot of these factors have started to come together, where you're seeing that almost there are several signs showing that economy is recovering, and the common thing that markets will always lead the economy seems to be proven right yet again. But broadly, the reason why people are moving out is predominantly on profit booking, and also the fresh memory that what if again there's a market crash and this market disconnect part. But the other important fact is that as a trend, it's starting to come down, and we are seeing a lot more interest from investors. So I think eventually, while the outflows still remain, but at least the quantum of outflows has reduced.
That it has. I mean, we are still seeing that sell figure appearing, but it has released. So that's, I guess, interesting. On the other hand, while we are seeing, more redemptions, etc., SIP accounts, the number of SIP accounts has gained traction. In fact, it has doubled. What's caused the spike? And we are noticing that especially in these last 3 months, since December, Jan and Feb, we are seeing an even bigger increase in SIP accounts. What do you think that has caused that? And in the market that we are in currently, do you think that's the best way to invest in mutual funds?
So with regards to SIP, I think there are two things which have happened. So if you look at the last year, the biggest concern for most of us was the fact that there was job losses happening on one end. There were a lot of pay cuts happening. So net, the real worry was there was no clarity in terms of future cash flow, which is essentially the salary component. So that was the biggest worry, because of which a lot of people had to stop or probably pause their SIPs. But at least in the last few months, there is a lot more clarity and confidence in terms of the stability of their salaries and other future cash flows. So net, that a real worry point of will my salaries be affected in the future, that is more or less done with. So more or less most investors that we talk to are reasonably confident on the stability of their cash flow. So that is one significant reason. And the second one is that if you look at the SIP returns, maybe 3 year, 5 year, 7 year, all returns looked really bad in the middle of the 30-40% crash that we all saw in March last year. But however, after that, post the recovery, all the SIPs, 3 year, 5 year, 7 year, all long-term SIP returns have significantly improved. So anybody who's seen that has probably got the best demonstration of how an SIP works, where like you stay patiently through the down, and that's essentially where you start accumulating more fund units, and net whenever there's a recovery, then the returns suddenly jump up. So most of them have seen that, and so essentially, one, there's clarity on future cash flows, and two, you've seen how SIPs play out over a long run, and all the returns look good at this juncture. And hence we think essentially these are the two reasons why most investors are starting to warm up again to SIPs. And as I told you, as we always re-emphasize, that SIPs are probably a very good option as long as you don't stop it in between and continue it over the long run. And in essence, the key thing to remember is that SIPs need an intermediary correction at some point in time, because that's when you get to accumulate a lot more units at a cheaper cost. And that's essentially how the product works. So net, market corrections are not something bad, but you have to pray for market corrections if you're a long-term SIP investor. So I think SIP as a concept will continue to be relevant at the current juncture and at all junctures.
Okay, so SIPs are definitely a great option, especially if you know you're going to sort of go through with them in a very disciplined manner. Let's talk now, Mr. Kumar, about individual categories within the large mutual fund umbrella, sector funds. So that's, I think, something very interesting, because we have been seeing a lot of traction over there. In fact, in the Money Show, on the Money Show email address as well, we get a lot of questions that are directed towards sectoral funds. And why not? You know, some of the best performing funds from any time horizon has been a sector fund. So yeah, inflows over here have been pretty good, though they too have seen net outflows only. But yeah, what's your view on retail investors putting their money in sectoral and thematic funds?
The way to think about sector funds is that they are high risk, but also they come with the positive of high returns. But the key point is that in order to get a sector fund right, one, you will have to pick the correct sector. That's one big challenge. And the second big challenge is that you also need to time it right, which means that you need to enter at the right time. And unlike a well-diversified equity fund where you can stay put for a long run, here the second important aspect is that you also need to come out of the sector. So in essence, like, you have to choose the right sector. And the second part is you also need to time the entry and the exit part right. Usually when you look at past returns, at all points in time, there'll be some sector which is the topmost performing fund at that particular year or 2 years or 3 years. But that the key point is that these sectors keep changing. So if you're looking at a particular sector and then looking only at the past returns, then you might be in for a disappointment. So I think it is only meant for sophisticated investors who can put in the time and have the bandwidth to do the analysis on which sector, how to time it and all that. But for most retail investors, I think a general well-diversified equity fund, and you just remove the element of picking sectors, you outsource the job to a fund manager, and I guess the fund managers can do a better job than most of us. So it's only meant for sophisticated investors.
All right. Now, here's something very interesting that I've observed in two categories of mutual funds. One is relatively new, and that's a Flexi cap fund, which was introduced by SEBI after the whole rejig in, the multi-cap funds, which mutual fund houses were asked to do. Post that, we saw lots of multi-cap funds, reclassifying that category, that particular fund rather, into the Flexi cap fund category. However, this month we've seen a net outflow of 4,000 crores from Flexi cap and a net inflow into multi-cap of roughly around 4,000 crores. What explains this? And I'm going to add in one more question here. Mr. Kumar, what goal do you think now this newly introduced category of Flexi cap can it help retail investors achieve?
Sure. So net, we wouldn't want to draw too many conclusions from this month's particular data, because there's been a lot of rejigging happening between these two categories. And as you rightly mentioned, a year back, we only had one category, which was essentially the multi-cap. But again, post the SEBI's different mandates for multi-cap, there was the additional category called Flexi cap, which was introduced. So right now, what is happening is that a lot of funds were earlier run like Flexi caps, but yeah, it was classified as multi-cap. So most of these funds are moving into the new category called Flexi cap, which means that there is also an exit load free period, and some investors who are looking for profit booking might find that as a reason to come out of these funds, especially if they have a short-term outlook. So that can be one. But net, if you really the better way to approach these two categories, if you put them together and see the trend, right, you would see that there's hardly any major change. So the outflow number is very, very minuscule. So we are not seeing any major trend change. So per se, I would say that at least for the next 2 or 3 months, till this whole transition between both these categories kind of settles down, we would like to wait it out and then probably look out for some patterns in terms of is there any particular investment preference for any of these categories. On a broader sense as to how to look at flexi cap funds, I think flexi cap is probably a core category where ideally you are letting the fund manager decide where is the opportunity, and net it gives the maximum flexibility for the fund manager, and most likely it will be predominantly a 70% large cap kind of a segment, with the remaining 30% distributed between the mid and small cap based on the fund manager's view on the market. Broadly, I think it's a great category for retail investors who do not want to take calls saying that is mid caps attractive now, is small caps attractive now, or should I go to large cap. This is broadly a reasonably balanced category where you can pick 1 or 2, 3 or 4 different funds from different styles and then put them together. I think net you will get a very, very good experience over long run. So I think it's probably one of the stable core categories for any retail investor who's looking to invest in equity mutual funds.
All right. Okay, so that's definitely interesting. Let's move to debt funds before I, take on board our viewers' questions and queries. I think short-term bond funds and corporate bond funds saw the most amount of net outflows. In light of what we are seeing in terms of, the spike in yields, etc., what's your view in terms of how investors should, place themselves across the different categories of debt funds?
What really happened was, if you step back a year back, you would have seen that there was a lot of credit events and a lot of articles written regarding credit risk. So most investors who were investing in debt funds were clear on the credit risk part of it, and hence there was a significant shift towards perceived safer categories like corporate bond funds, banking and PSU, the short-term funds, with priority towards funds which were running a high credit quality. But the other aspect, so the last few years taught us on credit risk, and the point was there was also a declining yield environment, which meant that the returns were also good. So on top of, net you had a good period where you had high credit quality giving you high returns. So a lot of investors had invested into these categories. But now what is happening is that the yields have started to move up, especially sharply in the last 2 months. One, because the government borrowing numbers has come like much higher than expected in the budget, and then there's global worries on inflation picking up, and globally yields are also spiking up. So net, because of which there's a sharp increase in yields in the last 2 months, and all these funds usually run a modified duration of somewhere close to around 2 to 4. And in debt funds, what happens is when interest rates move up, you have a slight negative impact on your returns, and the impact on your returns will also be dependent on how high is your modified duration. So higher the modified duration, the higher will be the negative impact. Now, in the last 2 years, it was a positive impact. So higher the modified duration, you had a higher positive return. But right now, it's just cutting back on the other side. So a lot of investors have got a little jittery after seeing some negative returns on a weekly or on a monthly basis. So that's the reason why they are starting to move. The key is, just like how the last 2 years taught us to evaluate credit risk, I think going forward, the next 6 months or next 1 year will also teach us on the other risk, which is nothing but interest rates going up. So whenever interest rates going up, there'll be a lot more volatility on your debt fund. So the way to position for new investors who are entering is to go for funds which have highest credit quality, predominantly AAA rated security. That's like the basic starting point. The second added part is on the interest rate risk part, which means that you have to go for funds which have a modified duration of, say, less than a year, so that your volatility is not too high over the next 1 year. Predominantly, it will mean categories like ultra short term or money market, low duration. So these are the categories where like there will be a much lower volatility if interest rates or if yields go up. At the same time, you will also get a reasonable return. So overall, the base is that you will have to prepare for a slightly more volatile environment for debt funds. But if you want to reduce the volatility, you will have to stick to funds which are at a lower modified duration. If you are looking at a higher duration fund, then you will need to go for a slightly longer time frame, and at the same time be okay with lower near-term returns, and most likely the returns will be rear-ended for funds which are at slightly higher modified duration.
Understood. Okay, well, you know what? Let me now, ask our viewers to send in their questions and queries on our email address, themoneyshow@etnow.tv. It's our Ask the Money Show segment. So very quickly, let me take on board our first question. We have Arindya Chatterjee asking, what are the best mutual funds to park money for just 3 to 5 years? I currently have 10 lakh rupees, which I can park for 5 years. So very clear about the time horizon, only 5 years. Post 5 years, Arindya will be needing the money. So for that period, Mr. Kumar, what category of MFs are best suited?
Yeah, so because the time frame is lower, right? That's the step one whenever we need to decide on any investment is basically to decide saying what's my mix between equity and debt. But because the time frame is only between, let's say, 3 to 5 years, I would suggest that do not go for equity, because as you know, the real problem of equity is not that 5 years is not enough, but if you're unlucky, then even in the 5th year end, let's say was something like COVID happens and then the market goes down by 30-40%, then your entire returns goes for a toss. So net, we would generally suggest that less than 5 years, pretty much stick to a debt-only portfolio. But if you think that the timelines can be extended further, maybe you can extend it by 1 or 2 years. They're not too rigid on the timelines. Then maybe you can add in up to 30% into equity. You can probably make it even safer by pushing it into a balanced advantage fund or the dynamic asset allocation category, where the fund managers automatically keep adjusting the equity allocation level. So net, you are building the second layer of conservatism on top of the original 70% into debt. So that can be a good combo if your timing is flexible. If your timing is not flexible, then we would suggest predominantly get into a 100% debt kind of a portfolio. And you can look at very, very high credit quality portfolio and also lower modified duration. But if you, let's say the alternate can be if you want some more stability or some more clarity in terms of what is the returns that you should expect, then probably you can also try out the roll down funds which are available, where you can look at whatever is their average maturity period, and roughly if you hold on for that particular period, you will net get a return which is very close to, there's a number called YTM which is displayed on all these funds, that YTM minus whatever is the expense ratio for the fund, that's the return that you can more or less you come close to. So those are other ways in which you can pretty much try to get a very stable return environment if required. So these are the two ways you can go about doing this.
All right. Okay, let's take on board our next question then. We have Karim Lama who's asking, is an SIP or a lump sum the best way to invest money? Should we do an SIP in debt funds? Okay, so I think you partly did answer this question, Mr. Kumar, when we were doing our Q&A before this, but SIP in debt funds, this is an interesting one. What's your opinion?
So, see, I think if you really think about SIPs more, it has more to do with our cash flows, because let's say if I am getting a salary every month, the SIP is more like a convenient option, because I don't have the option of, so each and every month it looks like a lump sum, but net, I don't have a large amount to invest right now. So net SIP is more like, it's more to do with my savings pattern. So if your savings pattern is that of monthly savings, then I think once you decide on your asset mix, so let's say the split is 70% equities and 30% debt. So the remaining 30% debt will automatically get an SIP into debt funds. So there's nothing wrong with SIP into debt funds. So the idea behind SIPs over equity funds working over long run is that it helps to average out the volatility. There'll be good phases where you buy at lower prices. There'll be bad phases where you buy at higher prices, and there'll be like majority phases where you buy at reasonable prices. Net, it'll average out over a long run and give you a decent experience. But in debt, because it's a far more stable asset class, usually if you have large amounts as lump sum, you can go one shot into debt. But if the cash flows are more like linked to your salaries, then there is absolutely no harm in doing an SIP into a debt fund. But SIPs into a debt fund is not to control the volatility, is more from your cash flow pattern.
Okay. I think we have time for one more question, so let's get to that. We have Anupam Malia who writes in saying, I'm 66 years old, investing for the last 8 years for retirement, have invested 60 lakh rupees, 60 lakh rupees ready to redeem. Please suggest the best way that I can redeem these funds with a minimal tax bill. He shared his portfolio as well. I think his portfolio and his spouse's portfolio. So he's got 3 funds: Aditya Birla Sun Life, Franklin India Smaller Companies, and HDFC Top 100. His spouse, meantime, has 4 funds: Franklin India Focus, which broker has discontinued, HDFC Small Cap, L&T Mid Cap, and Murray Asset. But now his question is that he wants to redeem these funds. This is a very valid point as well, that yes, you do your SIPs, you do it for a long period of time in a disciplined manner, and then you reap the rewards. But what's the most efficient way of reaping the rewards? Many people say you slowly start doing an STP or you do an SWP. Anupam hasn't mentioned, whether he's okay taking the money, redeeming the money in tranches, but let's assume that is an open option for him. How would you recommend he go about it?
So there are different ways in which you can go about with it. But let's say if you immediately need the money, but you're trying to evaluate the markets and then time the markets, I don't think that would be a great thing to do. So I think if you really need the money over the next 6 months, 1 year, the best option is to just redeem the whole thing and then get it out. But let's say if you don't require the money right now, but you're a little worried on the overall markets, and let's say you have another 3 years or 5 years to go, one option can be that you can gradually move it to a balance advantage fund kind of a category, where the volatility can get adjusted in the balance advantage funds. And net, as you go closer, let's say 3 years, as you go closer, you can do a simple systematic withdrawal plan from your balance advantage fund. So that can be one option. The other option is you start a gradual SWP plan right away into a very safe, high credit quality, lower modified duration kind of debt fund. And then you let it run for however long that you want, maybe around 2 years or 3 years, depending on what is the time frame in which you require the money out. But I would generally, let's say if you have a 5-year time frame to get your money back in the last 5 or 3 years, I think in essence you can either do a simple SWP into a debt fund, or you can use an intermediary parking into a balance advantage fund, and then eventually get it into a debt fund. So these are 2 options that you have.
Okay. Well, I think with that, I don't think we'll be able to take any more questions. So we'll leave it at that. Mr. Kumar, thank you so much once again for taking our time and joining us on
Thank you so much.
And well, with that, we will slip into a very short break. But when we return, we'll be talking to none other than Radhika Gupta, the MD and CEO of Edelweiss Mutual Fund, on yet another emerging category, which is seeing a lot of NFOs as well, the target maturity index funds. What exactly are those? Well, wait for this break to find out.